So how would you like to make an extra $200, $300, $500 a day in trading? Of course you would. You'd be silly not to. But I'm going to show you guys a way today that I use, a method specifically I use to make a little bit of extra cash on a daily or on a weekly basis in trading. Before I get into that though, let me quickly tell you something that's very important. I think as a general rule, thinking in dollar terms is a very tricky or potentially dangerous thing to do when it comes to trading. I think the better way to think about making additional money in the stock market is really more focused on your process of execution, sticking to your rules, sticking to your system. If you have watched previous videos of mine here on my YouTube channel, on my website, thesteadytrader.com, or whether you're using my B2 reversal indicator or you've taken one of my courses or you're a Clubhouse member, you know that I'm all about keeping things simple and repeatable when it comes to trading and active investing. At the same time though, I'm all about making sure that we look at the markets in multiple time frames. And so really when we talk about making a little bit of extra money, we have to make sure that we keep our time frames in order. Our near-term time frames, our medium-term time frames, and our long-term time frames. There are thousands of different types of trading strategies out there, just like there are many different ways of making money in life in general. What I'm going to show you guys today is just one specific method. There are many methods that I like to use to make additional cash flow on a monthly, weekly, quarterly basis. Some of those include using the options market, selling options, but I'm going to show you guys today is what I call the open gap trade. And we can use that trade every single morning at a specific time using various different instruments. It's a very straightforward trade. It's a trade that you can do whether you are looking at your computer in the morning or not. You can actually pre-set up that trade before the market even opens. So it's a trade that I like to explain to people who don't want to be constantly looking at the computer all day long as well, because that's my general sort of teaching method, if you will. I like to make sure that everything that I teach is something that everyone can do, and not only people that are looking at the computer the entire day. So let me quickly go to the screen, and I'm going to show you this very straightforward but a high probability trade of making extra cash on a daily, weekly, or monthly basis. All right, guys, so let's have a quick look here at the very essence and basic of what we call an open gap strategy. We're looking at the S&P 500 here. This is the SPY ETF, which of course represents the S&P 500 in ETF terms. So at the very essence, what we're looking at, a lot of times each day, the S&P 500 actually opens up either higher or lower than the previous day's close. In this case, you can see the S&P 500 opened up about, 220, let's call it about a half a point higher on that day. And you can see that over the course of the morning session, that entire up gap, which is this what we're talking about here, had been retraced. So the essence of these open gap trades are essentially twofold. There are two ways of trading these. Number one, when the market gaps up, and as long as it's not a breakaway gap, which I'll show you guys in 1 second, you can essentially fade these open gaps for a mean reversion move, which is to say that the open gap will be closing. So you would be shorting some S&P 500 near the open, maybe you wait a few minutes, or you sort of have a limit price of where you want to short it, and then you put in a buy price or buying back price at some point, maybe at the half gap point, which would be somewhere here, or maybe at the full gap closure. That kind of depends on your personal preference, and that really is something that you kind of want to develop over time. But this is a very simple and straightforward way of being able to generate some extra cash on a daily, weekly, monthly basis. Now, the inverse, of course, would be if the S&P 500 or whatever the contract is you're looking at, this could be another ETF, it could be a single name stock, by the way, it could be a futures contract, for example. If that were to open to the downside, you could then essentially buy that contract in hopes of that gap closing. The gap closes somewhere between 60 and 70% of the time, depending on the time frame that you use. A lot of gaps do close over time. In fact, something like 80 or 90% of all gaps close over time. Not all of them do. So this is really more of a day trade
that you want to look at. Now that's a very high probability way of doing it. You can see if I just kind of show you some examples, at least the what we call half gap tends to close quite a bit. For example, here we had that up gap. That's what I just showed you. You can see that gap ended up closing. Here the half gap closed, so we had a down gap, and ultimately we exhausted. We had a rally back, so the half gap closed. And so on and so forth. And then we have things called, sort of breakaway or breakdown gaps. And let me show you, for example, what they look like. Here's one more, by the way. Here's a gap that closed. We had an up gap, and ultimately you could see almost an entire close of the gap. So, 3/4, let's call it 4/5 close of that gap. So you can see that just by randomly poking around some examples here, that most of these gaps do close unless they are what we call breakaway gaps. A breakaway gap looks different. The breakaway gaps look something like this. You can see here on this day the S&P 500 opened higher and continued higher and higher and higher and higher and closed the day, in this case the week, actually very near the very highs. And the reason why this was a breakaway gap is because it was basically a breakaway gap or a breakout gap. Maybe for to use a different term, you can see the S&P 500 gapped higher that day, and it was never going to look back. So that's that kind of scenario. You want to do the opposite. Instead of fading it when you see that kind of breakout move, you want to actually buy it. So you want to go in, you'd buy some S&Ps and hold it for a few points if you're trading the S&P 500, maybe a half a point or so if you're trading the SPY, depending on your preference. So that's a very straightforward way of generating some extra cash on a daily, weekly, monthly, quarterly basis, and give it a try.
So there you have it. That's the open gap trade. I hope this was helpful to you. Please give us a thumbs up like on the video if you liked it. Subscribe to the channel and share the word about my YouTube channel. Thank you so much, and I'll see you in the next video.